Welcome, and thank you for joining us for today's live webcast and discussion. We invite you to be a part of the conversation. You'll see a chat box located near the video window. Click Chat as a Guest and enter your name. Feel free to enter your questions, and our moderators will forward them to the panel. We'll repeat these instructions later in the show as a reminder. It is now time to begin, and I will invite your host to take the stage.
Greetings, everyone. I'm Mike Begg, head of BMO's Canadian Commercial Real Estate Finance team. Thank you all for joining us today. I think we can all agree this past year has been a time like we've never seen. Banks entered COVID bracing for deeper impacts in the commercial real estate books. We were deferring mortgage payments to ease cash flow pressures for our clients that asked, monitoring income property rent collections and housing market trends, while we continued as lenders to support the large development and financing demand by the industry. I'll try not to steal our speaker's thunder, but to say the commercial real estate segment has done better than expected since last summer would be an understatement. The payment deferral programs I mentioned served their purpose and largely wound down last fall. We have not had any losses or defaults of any materiality in our commercial real estate loan book that can be attributed to COVID. Availability of capital across the segment has remained strong. We've had a veritable Z or nearly Z-shaped recovery because employment impacts were largely service sector, representing about 4% of GDP. There is pain and ongoing adjustment in retail and office, to be sure, but this is not your parents' or even our own prior commercial real estate recession experience, but a unique pandemic one where low rates and strong demand, continuing undersupply trends are driving borrowing and housing market activity. And we expect that to continue through 2021 and 2022 and beyond. We have a lot to cover over the next hour, so I'll walk through the agenda quickly and then we'll get started. We'll start with Robert Kavchuk, who will kick us off with an economic update. Robert has been with BMO since 2006 and plays a key role in analyzing Canadian regional economic, fiscal, and real estate trends. Following Robert, we will have a roundtable covering key topics and answer questions that were submitted. We're pleased to have two guest speakers joining us for that roundtable. We are honored to have Jay Westman, Chairman and CEO of Jayman Built and JWI Investments. Jay is a significant player in this region's real estate industry and has served as Chairman of the Alberta New Home Warranty Program, was a founding member of the Professional Home Builders Institute of Alberta, and has served as president of the Calgary and Alberta Home Builders Association. Also joining us is Kevin Comita, Chief Financial Officer of Qualico. With a strong background in real estate finance and analysis, Kevin has guided Qualico through opportunities for growth during his more than 25 years with that company. Moderating that discussion is BMO's Roland Ardiles, my team leader for the Prairies. Heading the Prairies region on my team, he brings over 20 years experience in real estate finance, overseeing both BMO's strategy and approach to financing of real estate, as well as the teams that are managing our complex developer relationships. So with that, I'll turn it over to you, Robert.
Great. Thank you, Mike, for the introduction, and thanks everyone for joining us today. So I'll start off with a higher level update on our economic views and a little bit on what's happening in the real estate market, some of the demand and supply fundamentals that we're seeing as well, because this is, to Mike's point, been a very fascinating cycle for us on the economics team, because we just have not seen anything like this. So I'll start at the high level and then I'll let the panelists take over and get more into the nitty gritty. But first of all, for us, from a forecasting perspective, it does unfortunately still come back down to COVID. And right now across Canada, you can see there that cases have in fact peaked. Vaccinations are pushing about 50% or so across the country in terms of at least the first dose. So we suspect that as we go through this third wave, that this will, for all intents and purposes, be the last wave. And as we get through the middle of the year, we're going to start to see an economy and just a social backdrop that starts to look a little bit more normal on a more permanent basis, rather than this rolling wave of shutdowns and opening and shutdown and opening. Unfortunately, the Prairies right now are obviously not a great spot to be from a COVID perspective. I'm not going to dwell on that, but overall, I do suspect that the pace of vaccination has picked up to the point now that we're comfortable to say that as we get into the second half of this year, we can hopefully put a lot of these rolling lockdown measures behind us. So from an economic perspective, what that means is that the second quarter is going to look tough. We're probably going to see a pretty flat growth for Canada overall. In fact, our forecast right now is actually zero growth in the second quarter. As we look into the second half of the year, though, as these restrictions roll off more permanently, and we get to a point where gradually, at least by later in this year and into 2022, we can start doing things like going to restaurants and traveling and going to hockey games and stuff like that again. We think there's plenty of pent up demand for this type of expenditure and this type of activity in the pipeline that's going to continue to support the economy well through 2022. So growth in the second half of this year could very well be running at 6 to 8% in Canada. We probably through the first half of next year are still looking at 4 to 6% growth. So that's a very strong run rate. And a lot of that does relate to the fact that we suspect that this third wave will probably be the last, at least in terms of significant economic impacts and economic restrictions for the economy overall. The other thing here that we can take away from this is that, and we saw this through the fourth quarter and the early part of the first quarter, as Alberta and Manitoba and even Ontario and Quebec were dealing with restrictions over the winter, the economy and the growth numbers and the activity numbers actually held up very well. And my sense is that a lot of businesses and households have learned how to adapt to this environment that we're in. So hence, when we do go through these up and down waves of restrictions, the economy has more or less been able to hold up better than, for example, in the first part of 2020 when we first started to deal with this. So the takeaway here is that it's a little choppy right now, but where we are with respect to vaccines and what the outlook looks like for the rest of this year in 2022 looks very strong. And I'll touch on a little bit of the factors later on, but you still have a ton of fiscal stimulus coming out at the federal level over the next 2 years, and you have a Bank of Canada that says it's going to sit on its hands and not tighten monetary policy, even though the near-term run rate for growth is going to start to look very strong. So with respect to the Bank of Canada, we don't see any interest rate increases right through 2022. The first rate hike that we're expecting, and you can't see it on our forecast there on the left because this scale breaks off at the end of 2022. First rate hike would be January of 2023 for the Bank of Canada. Now, that said, the risk is that I would say personally that we start hearing about some more chatter about the rate hikes getting pulled forward rather than back. And in fact, the last Bank of Canada policy statement, the bank itself already came out and said, you know what, we're probably going to be looking at interest rate increases about 6 months earlier than we previously thought, just simply because the economy held up so much better than the bank thought through the turn of the year. And therefore the output gap might be a little bit smaller. And all of those factors that drive the inflation forecast. The inflation picture itself is another factor here that the Bank of Canada just really can't ignore. We saw CPI numbers this morning. They were quite strong. They were quite broad. And I suspect as we go into the first half of next year, we are going to see an economy that is looking closer to capacity than most people would have expected. And you're going to continue to see some inflation readings that look elevated over the next year or two, or maybe even 3. Just because demand out there is quite strong, and we know that there are a lot of supply constraints through the production chain on both the goods and on the services side. Even little things like, anecdotally, firms that are allowed to open up in parts of the US now more fully are having trouble pulling labor back into the job market, either because they've moved on or because they're more comfortable just sitting on federal benefits for now. So all of these factors kind of suggest that inflation is going to be a little bit more of a sticky issue for the next couple of years. And I suspect that when you look at our rate forecast here, the risk is that maybe we start to see liftoff a little bit earlier than the market's expecting right now. For longer term interest rates, if you look on the right side of the chart here, we suspect that the market already is pricing in a lot of the good economic news that's coming over the next 18 months or so. So we can kind of expect a flatter upward trajectory for long-term interest rates, but we do still think that we're going to see an upward push in rates. In longer term interest rates, we're looking at 10-year yields here, eventually do settle back into somewhere in the middle of the range that we saw over the course of the last cycle. So for us in real estate, what that means is we've already seen 5-year fixed rate mortgages come up about 30 or 40 basis points, depending on your mileage. I suspect that we probably do see, another 20 or 30 basis points of upside just based on our interest rate forecast, which would take us, somewhere in the 2.5% range or so. But the takeaway here, though, is that at this point, it does look like we are still in this low for long interest rate environment. So from a cyclical perspective, rates will continue to back up from here. But from a longer term perspective, if our forecast here is right, that rates do settle in roughly where we were over the duration of the last cycle, you should probably see ultimately a similar landing spot for longer term mortgage rates as well. Now, with respect to the labor market, you can see our growth forecast here across the provinces. This is on the GDP growth front, how the prairies have more or less evolved here. So if you look at Alberta, 2020 was obviously a terrible year, not only with respect to COVID, but because oil production was shut in early on, and we had to deal with kind of a 1-2 punch of the pandemic plus the oil price shock. Saskatchewan and Manitoba more or less middle of the pack in terms of how deep the declines were. But you look out to this year and into 2022, Alberta rebounds, obviously stronger than the rest of the country. That's not to say we're exceptionally bullish on Alberta specifically. That's just more of an arithmetic thing, partly because we're coming out of the biggest hole. Obviously, the climb is going to be quickest. But look out to 2022. That's where I would say the real message here is. And that shows the prairies in more or less middle of the pack. So we don't think Alberta is going back to this 5-6% kind of real GDP growth on a sustained basis that we saw at various stages over the past cycle. We think oil prices around $60 or $65 is roughly equilibrium. That sets up the province for a more or less middle of the pack performance within the context of all of the provinces combined. And Manitoba and Saskatchewan are a similar story. Manitoba, of course, is usually the most stable on the landscape, and Saskatchewan a little bit less tied to oil prices specifically than Alberta typically over time. So a pretty stable middle of the road performance for most of the prairie provinces from a growth perspective. So zoom into the housing market here. And this has really been one of the fascinating aspects of this cycle so far. When we went through the first half of 2020, we didn't really see a big correction in housing. What we saw was more or less the market putting itself on hold as we dealt with that first round of the pandemic. And then when the market opened back up, it opened back up with vigor. So we saw a very strong rebound in sales and a very strong run up in demand right through the spring of this year. And it really hasn't let up all that much. Now, we are seeing momentum fade a little bit now as we get into the May and June period. But I mean, look at where sales are still in the prairies here, and the same can be said across the country. We are well off the charts in terms of record demand. So there's a lot of debate out there. Is there a supply problem in the housing market? Is there a demand problem? From a longer term perspective, I'm sure we'll touch on this later on, but yes, there are some structural issues on the supply side that need to be addressed. But just look at what's happened to housing demand. And it's record low mortgage rates. It's households looking for more space across a lot of the country. And it's households looking for recreational property because they can't travel. And I think one of the big factors on the demographic side is that there is a big bulge of the population called the millennials that was waiting to move into the housing market. And the pandemic was the push that they needed to pull a lot of those purchases forward. So look at what's happened to prices on the right-hand side. Across the prairies, I mean, price growth doesn't look nearly as dramatic as in some of the other markets in Canada, but I will say that for a market like Calgary or Edmonton or Regina that was stagnant for 5 or 6 years pre-COVID, who knew that the pandemic was the stimulus that the market needed to actually get prices running again? And we are seeing 7 to 10% year-over-year price growth in these markets now, which is unlike Toronto and Vancouver, Montreal, is a refreshing change in that part of the country that was dealing with this kind of very stagnant price environment for a long period of time. So what's driving it? I'll touch on some of the demand factors quickly. The labor market is one. You can see that the job market has actually improved pretty quickly from the depths of the pandemic last year. So the unemployment rate across the prairies now is about 7.5% to 8% or so, depending on the month. A little bit below the national average, but you can see how quickly that has come down off of last year's highs. And employment in a lot of the country is getting pretty well close to pre-COVID levels. And I suspect over the next 6 months or so, most of the provinces on this board here will see employment numbers that look very close to, if not above, what we saw in February of 2020 before the pandemic broke open. So the recovery in employment has been pretty quick. But the most important thing to keep in mind here is that when you look at the distribution of where the job losses are still lingering, they're very much down the pay scale. So this is just a quick chart that looks at industry performance across Canada in the job market relative to wages. And so as you go left to right on this chart, you're seeing better job market performance. As you go down to up, you're seeing a higher wage scale within that individual industry. So as an example, look at accommodation and food services. Employment there is still down about 30% from pre-COVID levels. Just so happens that's the lowest paying industry in Canada. So the takeaway for the real estate market, at least from a sales perspective, is that if you look up in the top right corner of this chart, the 5 or 6 highest paying industries in Canada are already seeing employment well above pre-COVID levels. The recovery there was extremely fast, and employment is already, as I said, above pre-COVID levels. So professional, scientific, technical service, finance, some areas of manufacturing, industries like that are higher on the income scale have recovered very quickly. So the demand curve, like as much as that unemployment rate still looks historically high, and that's typically a very close driver of housing activity, but beneath the hood, we're really starting to see that specific areas of the job market that drive housing demand recovered very fast. Those that are lagging, part-time employment, low-paying employment, and youth employment, typically you don't see a lot of home buyers in that segment of the job market anyway. So hence the very strong rebound in housing demand. On the demographic side, a couple interesting things are going on here as well. International immigration has been a big driver of housing demand over the last decade, but more acutely so since 2015 when the Liberals increased those federal immigration targets. And those tend to flow pretty well proportionally into the country across different regions. The issue now is that those are temporarily on hold, and especially non-permanent resident flows, which actually take up a lot of the rental stock in Canada. Those flows turned very quickly negative during the pandemic. We suspect that they're going to come back. It might take a little bit of time before we start to see those flows come back on a more sustained basis. This could be, a story we're starting to see play out maybe by the second half of 2022, just at the pace things are going right now. But the key takeaway here is that I would say this downturn we're seeing in the population from an international perspective is very much temporary. And we know that the Liberals are looking at immigration targets in the 400 to 450,000 per year range. That's that's a very, very strong level of inflows that we suspect are still coming into the country. Provincially, the Prairies are a region that tends to either draw in a lot of people or see people moving out, depending on the state of the job market. And unfortunately, that tends to be tied to oil. So what we saw post 2014 was we saw an end to this influx of provincial inflows into the Prairies, and those flows turned out. So a lot of people went back to BC, Ontario, Quebec, Atlantic Canada, just because of relative job market prospects. But where we are today, with oil prices around $60 or $65, which is relatively balanced, we've actually started to see these provincial migration flows balance out a little bit. So that kind of just highlights that, we're not going to go back to the kind of boom levels of demographic flows that we saw in 2006 through the financial crisis, or we saw post-financial crisis through 2014, but we could settle in somewhere in between where we see population growth in that prime home buying demographic growing at about 1 to 1.5% or so once this pandemic passes. And the last aspect here is the millennials, which I mentioned already. They are creating households, and they're creating a lot of demand for single detached, especially as they push into the 30s and they start having kids. And that's one area of the demographic story in Canada that does not get enough play. It's the biggest cohort in Canada. The leading edge of that cohort is now fully into their prime home buying years, and we probably have another 5 or 6 years of very acute demand for housing just simply from that millennial cohort coming down the pipeline at us. So that's largely the demand side. So where does that leave us? So the Prairie market obviously is extremely tight, as you all know. So right here, you can just take a quick look at sales to new listings in the blue line. It's a very tight market. It's probably the tightest market we've seen since 2006, 2007. And anybody in Alberta during that period knows what that market looked like, where we were seeing prices running up at about 50, 60, 70% year over year. So prices pretty clearly do track the market balance. And as you can see, prices have accelerated just because the market is so tight. And it is mostly a demand story. If you look at new listings specifically, they haven't kept pace with sales, but they are coming to market quicker than we saw post-COVID. This is really a case where the demand increase has been very acute. So we suspect as we go forward through the second half of this year, the market's still going to remain very strong. The Bank of Canada is still guiding to low for long interest rates here, which is supporting demand. And frankly, in some of the bigger markets, probably starting to pull some speculative activity in as well. What's going to be interesting is that if we do start to open up more fully through the second half of this year, and especially 2022, I think there might just be a natural cooling mechanism in here, because I suspect a lot of the demand we're seeing today and over the last 6 to 12 months or so was activity that was probably pulled forward from the future. So it stands to reason if we are borrowing future activity today, we're going to pay that off over the next couple of years with sales kind of settling back down towards more normal levels. And it's this is fascinating for us because it's almost the reverse of every cycle you typically see going back through time, where during the shock itself, the housing market weakens, and then as the economy comes back to normal, housing tends to accelerate out of the recession. This is almost the opposite, where that pandemic pulled a lot of demand forward, and as we return to something that looks more normal, we actually could start to see housing market activity soften going forward. So that's roughly where we are on that. So the rest of this year looks quite strong. On the supply side, then the prairies are a little bit more well supplied, and a lot of this is just a overhang of some past activity and some past weakness. But you can see what's happened over just the last 6 months or so. That standing inventory out there, and I use Calgary as an example here, but most of the region looks pretty similar because demand is so high. That inventory is starting to get worked down, and we're still at the current rate. I mean, you can see in the chart here pretty clearly, we're still probably 6 to 12 months away from getting those inventory levels back down to more normal from a historical perspective. But at the rate we're going, I suspect that the market's going to look quite a bit tighter still going forward over the next 6 months or so. So one issue that we've been getting asked a lot, and I mentioned inflation earlier on, is whether or not this inflation story is for real, and specifically in the real estate industry, if this cost pressure is going to persist. And I think we are of the view that we need to be giving this inflation story a little bit more respect than maybe it's been getting. There is fundamentally, when you have a pandemic like this, it's a negative supply shock, right? So you see a big adjustment in demand in various areas, but you also see supply kind of get constrained and production change choked off a little bit. So from a textbook perspective, this pandemic should create inflation. And look at all the factors that are leaning towards more inflation right now. You have fiscal stimulus, the likes of which we've pretty much never seen before across the developed world. I mean, Ottawa pushing out about $300 billion worth of new measures. That's more than 10% of GDP. This is unheard of, going back to effectively World War II area in terms of government spending. That's inflationary. Look at what central banks are doing. They're running full-scale QE programs in the US and sitting at record low, basically zero interest rates, and promising to keep them there well until the recovery is underway. That's very inflationary. And then, of course, the supply and demand dynamics are quite inflationary too, with very acute demand for things like home renovations and goods and new construction activity that's been creating a lot of demand for things like lumber. And these factors have rippled right through the supply chain. So what I tend to say is, from an economic perspective, is that when you see a new trend like this start to emerge, a lot of people tend to underestimate it at the start. And what I tend to believe on these things is that when you get a shock like this, the fallout tends to run stronger and longer than most people initially think. So I do think that we could be setting ourselves up here for a period where we have not just a 6-month increase in inflation until the pandemic is quote unquote over later this year and then it goes away. This could be more of a a 3 to 5 year period where we have inflation not running up to double digits like we saw back in the 70s and 80s, but running at maybe 3-4%. And that doesn't sound like a lot, but considering that inflation in Canada and the US has been running at 1.5 to 2% going back over the last decade, that's a doubling in the inflation rate going forward that could really start to feel a little bit different. And then the housing market specifically, so I don't follow lumber prices and copper prices, steel prices very closely and make hard forecasts on them. But this is very much the same story where we have a very strong demand for these commodities, but very tight supply. And in fact, if you look at lumber supply going back over the last decade, we were kind of structurally undersupplying ourselves because of the big fallout from the financial crisis that obviously hit U.S. housing demand so hard over the past decade. And very quickly we saw demand turn around, and I think we're going to be undersupplied on things like lumber here for some time going forward. The other aspect is on the labor side, and I touched on this a bit earlier as well. We're starting to see more signs that there is a little bit of a scarcity for skilled labor, for trades, for example, out there. And I mean, the hope is that as the economy opens and the restrictions come off, this labor is pulled back into the labor market. But there is some concern that the supply of labor has been permanently hit a little bit. So we're going to have to see how that plays out as well. But so the bottom line here is that you can see construction costs on the residential side, and this is an inflation measure from StatsCan, but we're looking at 15 to 20% year over year cost price inflation. And I mean, we see this anecdotally, we confirm it anecdotally, we see it in the numbers as well. You go to the hardware store and try and buy a 2x4, you see it in real life as well. So this is something that, I mean, just the acute nature of this might hopefully dissipate over the next 6 to 12 months. But I struggle to believe that we're just going to very quickly go back to normal on this until we can work off some of the impacts of the pandemic, and that might take a few years going forward. So finally, just very quickly on the rental side. So I mentioned the job losses being more acute in the lower paying and younger workers. Fortunately for us, we did see a very aggressive rollout of various federal programs that have helped keep tenants in place. So we have seen across the cities vacancy rates back up. We've seen rents pressured lower, but it hasn't been as dramatic a fallout, I think, as most people might have thought early on. The non-permanent resident flows, as I mentioned, I think those are going to come back. It's just going to take some time. We're going to have to probably wait a while. We've seen a shift from longer-term rentals out of short-term rentals, especially in the major cities where travel has been completely disrupted. A lot of that supply that was being used on the short-term rental market, just simply because cash flow was better, was recycled back onto the long-term rental market, and that effectively brought forward some supply that we were needing in some of the major cities. Not as much in a Calgary and Edmonton or a Regina as in, say, a Toronto or Vancouver, but that is one of the factors we've seen as well. So going forward, where I would leave this is that across the country, we still do see very strong demand for single detached creeping up on us because of the underlying demographics here. It's very acute in markets like Toronto, Montreal, Vancouver, less so in a market like Calgary, Edmonton, Regina, where we're not nearly as supply constrained from a space perspective. And in the condo market, I do still have this belief that the bigger cities in Canada are going to come back stronger and quicker than most people think. So Calgary is kind of a unique story because of the exposure to energy and the commodity market, but a market like a Toronto or Vancouver, I think, are going to come back very quickly once these restrictions start to come off. So I will leave it right about there. So just to summarize for the region specifically, on the oil side, which obviously is a big driver of economic activity and demographic flows, I think we're pretty neutral on that. Our forecast for oil prices is pretty flat from here going forward. It's an environment where we see strong cash flow and strong sustainability fundamentals in the energy sector, but is it enough to drive capital investment that creates a lot of jobs and pulls people into the province? Probably not at these levels. You need probably another $20 or $30 of upside in oil before we go back there. So it's a very stable, very neutral environment. The demographics on the prairies, I would say, are quite positive. The lull that we're seeing now is probably temporary from an international perspective. But the positive is that we do have the youngest population in Canada in that part of the country, and as I mentioned, that millennial group is coming on strong. Affordability is also very strong, so there is a compelling case to be made for that part of the country if you can find solid employment, just simply because relative to income, you're probably paying half or less versus a market like a Toronto or a Vancouver. The challenges, though, they always do come back to oil, and we think that longer term there is going to be this kind of push more towards clean energy. That's going to be a bit of an issue, and then the fiscal situation on the prairies it's a little bit province specific, but we saw Alberta get downgraded a couple of days ago by S&P, and that's an indication that there is probably as much as the fiscal taps are still open in Ottawa. There's still some more consolidation and fiscal restraint coming down the pipeline, especially in Alberta. Saskatchewan is quite a bit better shape, and Manitoba is probably in between. But in Alberta, there's some fiscal restraint coming for sure. So I will leave it at that, and I will turn it back to Roland to get the panel going. And thank you everybody for coming on.
Thank you, Robert, and welcome everybody. We're now going to be moving into our panel discussion portion of this presentation. And as Mike mentioned before, we have two special guests with us. Jay Westman, Chairman and CEO of Jayman Built and JW Investments. Jay, great to have you with us today. Your company has been a staple of the Alberta market for now 41 years. That's quite testament, to the family legacy. That you and your father built, and also Kevin Kamita. Kevin, Qualico has also been a staple of Western Canada, builder developer community for the past 70 years. So thank you again, both of you gentlemen. Along with Mike and I, we thank you for your participation today. We have a number of questions that were provided by the registrants, to this session. So we're gonna try to get to them as much as we can, as many as we can. So let's jump right into it. Robert talked about demand and the housing market. One of the questions that came up was, do you guys see a bubble, housing bubble, I guess, in the Calgary or Edmonton market? I'll maybe also, tap in Mike, maybe to talk about the national scope. But why don't I, throw this to you first, Jay, and maybe let's talk about that in terms of demand for housing.
If I could maybe have pull up in the slide the Calgary single family MLS sales. Can we pull that up? Yeah, what we have here, this wasn't the sales, but this graph will do. I can talk about this for a minute. What we've had happen is a super cycle happening in commodity prices that we've never experienced in 2 generations of house building. We've seen the calculation down here on average is about 16%, and the graph that we show is our large estate homes with the Calgary front drive homes, and then we show here Edmonton a little bit lesser so in terms of their average pricing. So laned homes and double car garage homes at 16 some percent over this short period of time. The graph I'd like to go to, if we could now, this is actually the end result of the super cycle of commodity pricing, but maybe we can just go to total MLS sales. You might not have that slide. What I was going to go through, and maybe let's take the slide off and I can just talk about this for a minute, is we've seen total MLS sales escalate, and we've been tracking now on a weekly basis. So what we've seen happen coming through the pandemic is we say that 2019 is an average, and we went like this. We went down, way down to maybe 100 sales a week. We did that for 3 or 4 months, and then we went past the 2019 average, and we thought, okay, that's deferred demand. Now what's happened coming into 2021 is we've now seen the sales on a weekly basis, basically in Calgary and Edmonton, outperform not only 2018, 2019, but we've seen them outperform 2014. And for Alberta, that was when we still had oil at $80 a barrel. And so we've seen MLS stats start to climb. Now, what that did was push traffic up into our show homes and our product, and we started to take off. And we had, I don't know, I think for the province, we sold 100 homes in the month of January, and we moved the price up. We sold 100 homes in the month of February, and we moved the price up. And we started to keep on getting price increases on lumber that was getting exponential. And now we're all the way into trusses and floor joists. And now we're having supply chain issues. So supply chain has become a slinky effect going through the market. All of a sudden it was compressed, no demand, then a bunch of demand. And in Edmonton, yesterday, traveling through the field, we're seeing things there that we can't get, floor joists of all things. And I've seen, my dad always said, he who handles the shortage best wins. Well, I've seen shortages of money, I've seen shortages of land, I've seen shortages of labor, but I've never seen shortages of floor joists. And anyway, that's what we're working with right now, and shortages of framing labor because all builders and all sales have taken off. So asking about the housing bubble, I believe that it can't continue at these demand levels. Here, you could see by the pricing graph what we've had to do with pricing. And I mean, somebody building a small deck in their backyard, they could buy a Hyundai car instead of building a deck. So it's it's gotten a place that it's got to have a curbing effect on demand in here as well. 62% of our buyers over the last number of years, 3, 4, 5 years, have been international in migration. And we know that because we ask them if you've been in Canada 4 or 5 years or longer. And so the buying demographic has changed. And so we still have that cohort buying today, but we're not sure, just how far a spread it's going to be before they open up international borders. So we can't continue at this pace going up. The however part, and I think we're bringing demand forward, the however part is I do think by fall or by the end of this year, we are going to see in-migration come back, international in-migration specifically. And I think this will help to mitigate this bubble effect.
Thank you, Jay. Kevin, anything you can add to that? Particularly, obviously, looking at the other, prairie provinces where Qualico operates.
Well, I would have to agree with most of what Jay has said, and we've seen that ourselves in Alberta. Steady price increases, essentially on a weekly basis. These kind of run-ups, and especially in markets perhaps like Calgary, Edmonton, where pricing has been quite flat or stagnant for a while, and demand off of quite high levels. When it starts picking up, you don't want to be a builder taking a whole bunch of sales and then not locking down your price side or your margins. So that's what we've been very focused on. Is making sure we're ensuring our through cycle returns and margins that we're booking at the time of sale are going to be there when we close. And as Jay has elaborated, and Robert, it's very challenging right now. And I would say that's pretty consistent in all our markets, and even across North America, our U.S. operations. Very similar as well. High demand. Robert touched on the millennial cohort coming through. We've sort of in the front end of it, maybe in Canada. We've seen a lot of that in the U.S. And so demand has been very strong. But again, the supply chain and supply side bottlenecks are an issue, and trying to maintain those margins through the construction cycle.
Thank you, Kevin. I think maybe one of the themes or topics that has come across actually a lot of the questions, of course, is the escalation of costs. And I think you both touched on this right now. maybe if I can ask you both to think back. Obviously, you've been around for a while in this industry, and think back to the past 20 years or so, and maybe look at similar inflationary periods. Well, one of the questions that came in, was if there was a piece of advice that you could give yourselves, having gone through maybe those times, what would that advice be based on what we're going through right now? Jay, why don't we start with you?
Well, the only thing that I think closest to this in escalation was in our case, basically the 05, 06, 07, peaking out in 08 in Alberta in terms of demand. Basically, demand was so strong, build cycles were taking an extension of a year and a half, and we basically couldn't supply the market with the demand. So we seen prices continually move up. Now, part of that was we were sort of hedging in terms of the pricing, and some of that was margin in that hedge back then. This particular one has been led by commodity and is sharper. So I talked about prices moving over a period of 24 to 36 months. This particular move here in commodities, the angle of increase has been in 6 months. So the advice, actually, I like Kevin's advice here. You are trying to not oversell basically what you can actually deliver, and you are trying to lock in your profitability or your margin, the difference between G&A and basically gross revenue coming in. And I have to tell you, in all the years, I've never seen the pace of change this fast. In my experience, not this fast. And Kevin mentioned weekly, and it is weekly. It's weekly.
Yeah, I think all I can add to that is, as has been said, the increases on the commodity side have been very steep. Geographic diversification really hasn't come into play. You don't typically have all markets rising at the same time, but demand has been pretty much strong across the board in North America, so which just exacerbates the supply challenges. I think I would sometimes when markets get frothy and sales are strong, everyone feels good about themselves, and as they say, everybody looks like a genius in an up market. So I think we don't want to think we're too smart, and we want to try and stick to our discipline, and not be focused on volume or sales numbers so much as the bottom line results and margins, and that hopefully we can. We don't want to come out of this and build a whole bunch of houses and find out a bunch of it was just done for practice, because we haven't priced in the cost increases that are coming down the line.
Thank you. I think maybe, sorry, do you have a
Roland,
question?
I'd like to make one statement. I guess I was just thinking about, what advice would you give yourself? And it was something my dad told me. The company or the person that handles the shortage best wins. And so today we're having to take a look at shortage in different supply chain areas and shortage in labor there. And so the companies that handle those areas best and really focus in on the issue of the day or the month or that quarter here, they do win.
Very good advice.
Maybe to that point, that's one lever that we try to use to manage some of this, and that's our scale and size and capitalization, and our vertical integration. We have supply companies like lumber and HVAC, plumbing, etc. So we've had a big focus for a number of years on corporate buying side of things and developing those relationships, and those have helped us a lot through this cycle. And for the lumber guys, it is we're of course a preferred customer, as all their existing customers are. They're trying to meet the needs of their customers, but the demand for commodities has those guys kind of in a bit of a situation that they would like to be taking on more customers, more market share, but they don't have the material side to follow through on it. So it's tough for them to manage as well.
Thank you. If I can maybe shift the conversation a little bit, obviously throughout the pandemic, there's been other sectors in the real estate space, that have been affected. Certainly the commercial retail space, has been one, that's been severely affected. But we've also seen an uptick on the residential rental build. Both the Calgary and the Edmonton markets are going through a revitalization of their downtowns. There's been build up on rental projects in those areas, but also there's been a focus on maybe the grocery anchored and the pharmacy anchored retail space. What could you maybe talk about in terms of where you see this trend happening? Is there going to be a recovery on the retail side, and are we overbuilding perhaps on the rental side in our given markets?
Defer to Kevin. Has got their portfolio is much more diverse than us, and I do know that we have one luxury rental project that is renting in a particular project at the rate of about 10 to 15 a month. But that's all basically we're not as diversified as what Kevin's company is. So I look forward to hearing Kevin's answer.
Well, we're not really in the new rental. We have a rental property portfolio that's existing properties, but we're not doing a lot of or doing any new rental property development in Canada there. But we do know there has been a lot of it done. There's been a lot of additions to supply. I think, as Robert was indicating, for the most part, it's been taken up pretty strongly. But there has been a lot of new supply added, and maybe vacancy and absorption is slowing down a bit. It's good to hear that the link to immigration, and when that starts coming back online, that maybe that will continue to take up that supply. In the U.S., we've been in the merchant rental property development business for a number of years here. The dynamics are a little bit different there. The rent growth is very strong, and we've rode that wave that's been going on there for a while with declining interest rates and cap rate compression. That business has been very good, and take up and absorption of new product has been very strong. But specific to Canada, I would I would be a little, returns on costs are pretty slim in that game from the outset, and it would be an area that I would be cautious in.
Roland, maybe I'll interject with a comment about our commercial real estate trends across lenders. And I can say that this is probably true across the major banks, not just BMO, but we've had minimal defaults and virtually, no losses at all in our commercial real estate book. None that we could attribute directly to COVID, and none otherwise really this past year. So it's been kind of squeaky clean in terms of debt books. Residential and industrial have tight supply and strong demand trends. Rental, was shored up somewhat by CERB. We would have seen, I think, a bigger impact because of the service sector impacts on employment there. but CERB and other government relief helped short up rental. So I think CMHC announced a year-over-year vacancy stat nationally that went from like 2% to 3%. So, we'd say that residential and industrial have tight supply and strong demand trends. And, retail, that's a different story. Most of retail has done reasonably well in recovering, but there is a component of that retail that we know is more in the service sector, restaurants, bars, fitness centers, and extending into things like hospitality, that they can't really recover until social distancing is behind us. But those really hard hit sectors that can't recover until social distancing is behind are really about 4% of GDP. So that means 96% has been rebounding well, really since last summer. And so stable retail growth will come later this year after fuller vaccination and all retail is reopened. And office is going to take a couple years to adjust. And so, maybe the dent in demand over that period could be 10 to 20% based on some of the comparison of notes between me and my colleagues like Robert and others in the industry. But that's, in my mind, more of a reset. And after that period of adjustment and reset, there should be a resumption of growth tied to economic growth. So in short, it's a fairly stable, positive outlook. And I'll just say one other thing quickly on the supply topic that was being discussed by Kevin and Jay. Lenders have a role in stable capital supply, as they well know. And I think that overall the banking industry in Canada kept that stable supply of capital. We saw our pipelines drop 30% last year. Yes, the risk trends at the outset were unnerving, but I think the banks did a very good job in maintaining that flow of capital. And, for example, when we went to our board looking at this year's needs for capital, we made it clear that we thought that the risk was more in terms of the upside and the overperformance of the segment rather than the downside. And we monitored for that. And as that became more evident, we deployed more capital into this industry to meet the supply. So that's how I'd comment maybe on both the commercial real estate side as well as picking up on these good supply comments of Jay and Kevin.
Thank you, Mike. Maybe what I can, ask you both, Jay and Kevin, Robert made a comment about, the fiscal stimulus that has come across and it's unprecedented. What are your thoughts in terms of the federal government instituting policies, that will specifically benefit our markets? What do you think we need in our economy before the prairies can bounce back? Anyway, just, some of your thoughts on that. Jay, why don't we start with you?
Well, as we know, they seem to make, the Canadian government makes policies for all of Canada, and we get, we seem to anti-cycle or different cycle compared to Eastern Canada. And so, interesting. I do think one of the things that they are going to do is everything, this green movement and this eco thought process and how we want to get to net zero by 2050. I think there's going to be some movement in that regard there. And that's something that we'll have to sort of keep an eye on in terms of that trend. I would love to see some different trends coming across how they handle qualifying and other things for this province or Western Canada in comparison to what's happening with Vancouver and Toronto. But I think that's a bit of a pipe dream. So that's the only thing I think is going to happen is something happening in this green movement here by the federal government, provincially and probably municipally. This is where all governments seem to be going. Here, this is the current, what I call, this is the current macro trend. And so we're going to have to be aligned with that when it comes to communities and housing there in order to take advantage of that.
Thank you.
I would echo Jay's comments that I would like to see federal policy that would benefit the industry, but I don't think I'm going to bank on it. A lot of focus on things like interest rates, mortgage stress testing. I think that kind of takes away from what the fundamental issue is, and as Robert was elaborating on, is there's the issue is trying to encourage the supply side response for the level of housing inventory out there. If governments, whether federal, and this maybe gets a bit more down into provincially and municipally, opened up or encouraged the supply side, we're developers, and we will build if we are given the opportunity. And often, the issue becomes more overbuilding. So I think that's where there's too much maybe focus on sort of short-term band-aid solutions to try and slow down the demand side, but the longer term or the bigger issue is encouraging supply side and encouraging development and growth in housing supply.
Thank you both, and we are coming to the end of our time here. I just wanted to maybe ask you to leave us with a couple of thoughts. We're seeing more people getting vaccinations, and I guess we're all envisioning, the world post-pandemic. How do you see that will look like, post-pandemic? I guess in the next little while. If you can maybe give us your final thoughts, Jay.
I think it's going to be joyous, and the reason I say that is I spent some time down south, and we were there asking each other in the community that I belong to, have you been vaccinated? Yes. Have you been vaccinated? Yes. And next thing you know, we went from fist pump to handshake to hug, and in the case of the girls, kiss. We danced on a dance floor there. They had an opening event outside, and we danced on the dance floor, and everybody was so refreshed with that. And so as somebody who's invested into three different restaurants, I have hotels in Western regions here of in Alberta and Saskatchewan that we've put in that. I can't wait to see the restaurant business open. We were almost doing in one restaurant, by the way, when the patios were open, we were almost doing as much business on the patio as we were inside before COVID. So I see travel, I see entertainment, I see these areas, I see consumers going to be ecstatic coming this fall. I really do. I just do. God, am I hopeful.
I certainly would. I hope that comes true as well. My hopes are even not quite as exotic. Being in Winnipeg and being very close to the Ontario border, a lot of people here have vacation properties in Northern Ontario or Lake of the Woods, and we can't even get across the border these days. So I would agree. This pandemic has gone on longer than probably any of us expected. I certainly wouldn't have thought, I know the spring of 20, I was wondering how it would impact things like going to the cottage, and I would have dreamed that in 21 I would actually be shut out from being able to cross the border. So when this starts to open, and even business in general, I think things will, and I think as we're seeing in the U.S. and other parts of Europe, things start coming back quite rapidly, and maybe in some cases too fast. But I think there is a lot of pent-up demand out there, and I think on things like commercial office, I would agree with the comments that the stay-at-home or work from home or not having office space, that's maybe, that worked in the short term, but I think most companies will look, and on a long-term basis, it's pretty hard to build teams and culture when you're having Zoom calls and you're not having that face-to-face and physical interaction. So I think that as we get control of the pandemic, that we'll see that things will not go back 100% in terms of office the way they were, but that will come back, and there certainly are a lot of jobs that and in terms of efficiency and effectiveness can't be done indefinitely from home.
I totally agree with what Kevin said and what Jay just said as well. And all I'll just say is real estate's an in-person business. We want to get back to seeing you guys and our colleagues in the industry at their project sites. Virtual meetings, they won't go away, but we need to get back to dealing with each other in person and traveling to see each other when we need to. So I'll leave it there, Ron.
All right, well, listen, thank you all very much. I mean, this hour has blown by very quickly, lots of topics. And to our audience, thank you again for joining us. We hope you enjoyed today's session. And want to thank you again for taking the time, to spend this time with us. On behalf of BMO, we want you to know that we're thinking of you, your families, and your organizations. We're here to help. We've been through uncertain times over the more than 200-year history of our institution. We have a strong capital position, and we're well prepared to serve our clients. We hope our firm's commitment to the real estate industry and our commitment to you, our clients, has been discernible during this discussion. As a reminder, today's call has been recorded, and we'll be making it available to you by way of an email link, that will come to you in the next few days. Additionally, if you submitted questions that were not answered, we'll try to address this and provide you additional information subsequent to this call. This concludes our call for today. Thank you, be safe, and take care.